This man is a West Point Military Academy graduate and served in our armed forces. So can we give it up for Christian? Thank you for your service. My friend, is there anybody else that served in the military in this room? Please stand up. Please stand up. Any other service members in the building? Please stand up. Let's give them a round of applause. How about any teachers in the building? Any teachers in the building? Please stand up. Any teachers in the building? Okay, we're not teachers anymore. Okay. All right. But I think teachers and military, man. Oh, God bless them. Right? God bless them. Yeah. So Christian, in addition to that, he after being medically discharged from the military, he went back to school, right? Got your MBA from UT McCombs. It's a pretty cool school, right, to get an MBA from. Got into the healthcare industry. He was very, very successful in that space. And then around 2017, transitioned full-time real estate investing, multifamily assets. He did a very cool strategic play in Temple, Texas, right down the road, where he took a tall office tower, right? Everybody knows office is like the best asset type right now. Everybody wants office right now. No, very, very opportunistic play right now, right? Because they can get it, you can get it at 50 cents on the dollar maybe. And so he took advantage of that, grabbed a big tower in Temple, Texas, and repositioned it as a Courtyard Marriott, right? Pretty strategic play. Again, you'll hear me say strategy, strategy, strategy. That's what makes amazing deals. And he's going to tell you about another one. I'm excited for y'all to hear about this deal. He's going to tell you about some amazing deal. But really what I love about Christian is his heart to serve, right? I mean, obviously he started with the military, but it's extended beyond that. Every time I talk to him, he's just like, Mike, I just want to serve. Mike, I just want to serve. I'm like, hey, let's talk about your compensation. I just want to serve. Like, okay, well, we're going to pay you. I just want to serve. You know? He's got a heart for service, man. And just character, integrity, and brilliant mind, which you're going to witness here in just a minute. But let's all give Christian a round of applause. Welcome, my friend. Okay.
Testing it. Okay.
There you go. This is your clicker. Okay, perfect.
So Mike took us to church earlier showing us all those scriptures in his presentation, so I've got a confession to make right off the jump. I'm not a coffee guy, I'm a tea guy, but specifically decaf green tea, which we did not have. We had regular tea, so caffeine, I'm kind of jumpy, so we might get at it here, so this is good. Just a quick story, since Mike mentioned it, I was born on a dirt floor in a third world country. In the Philippines, byproduct of an American sailor and a local gal, my mother, who 9 months later, there I was, right? That's sort of how it works. My wife is a labor and delivery nurse, so she schooled me on how stuff works there. So I got the chance to come to the U.S. at the age of 6, right before I turned 7. And life is much different here than it is in the third world country. And so, to whom much is given, much is required. And I had this burning desire, I want to help give back and serve this country that I had the opportunity to come to. And fortunately, I was gifted academically, athletically, was recruited to play football at Army, which is, I did not know the Army-Navy game was associated with the service cat. I thought it was one day a year, a bunch of sailors and a bunch of soldiers got together and they get to love and play football. I thought that's what it was, which is weird, but I got to play football there, but I incurred a lot of injuries. And because of that, I ended up getting medically discharged, as Mike said. That turned out to be a blessing in disguise because that prompted me to pursue a career in healthcare, and I'll tell you sort of how that comes full circle to what I'm doing now. So this is what I'm going to do. I'm going to tell you a little bit about myself, my background, my company. I'm going to talk to you about the process of doing a deal from beginning to end, and I'm going to try to super simplify a very complex process. Let's give it to Marco, by the way, who walked us through that due diligence underwriting. Anybody who knows how to work a spreadsheet in Excel like that just deserves a lot of praise, in my opinion. But it can get as complex as you can make it, but you can also simplify it, which is what I'm going to try to do with my portion of that, okay? And then I'll also share a case study and sort of what I'm doing now with regards to a medical real estate fund that we have currently available for those who might be interested in that. So first of all, the name of my company is Redeem Investments. We're a faith-driven real estate investment firm based right here in Austin. We specialize in medical real estate, and we really do try to aim to transform properties and communities wherever we invest. These are our core values, so servant leadership, integrity, relationship focused. Similar to duty, honor, country in the military, we take words very seriously. Our governance is based on this. We hire and fire based on this. My company is owned by service-disabled veterans like myself. We are minorities, and we're considered emerging fund managers. That's anybody who has $3 billion or less under management, which is where we are right now. Significantly less than $3 billion, but we're working our way there. Again, my background, spent 20 years in healthcare. Got my MBA from UT McCombs after about 7 years of work after the military. And then, as I mentioned, really combining now my healthcare experience with commercial real estate after I started in 2017 up to now. We did start off in multifamily. So all the things that Marco was talking about, very familiar with the intensity and the level of underwriting that you have to do within the operational aspects of that. What's different than with what I'm doing now is with medical real estate is they're triple net leases, right? Which simply implies that all of those things that we were looking at for operating expenses are the responsibility of the tenant and not the landlord. Okay, so there are other risks and other considerations that we deeply dive into, primarily the credit worthiness of the tenant, as opposed to the operational expenses and operational aspects of the property itself. One thing that I'm really proud of with this new investment fund that we launched is we incorporated, this is our third fund, but this is a piece that we incorporated this time around that we didn't have before, and it's an investing with impact piece. And essentially what we've done is we've created a foundation called the Redemption Foundation, and from our GP profits, we donate a portion to charities that are committed to suicide prevention, right? So you see, various ones out there. I'm rocking my Just Keep Living Foundation. So Just Keep Living is Matthew McConaughey's foundation. I'm actually a speaker for them, so I go to local high schools and speak on their behalf. There's several ones there that are focused on veterans, so Stop Soldier Suicide, Mission 22, Oath. Sadly, there's just a high prevalence of suicide among veterans, and so that's something that I'm passionate about impacting. To be clear, we don't erode our LP returns by doing this. We invite our LPs to come alongside us, as well as folks in the community. In fact, there's a QR code on the top right there for those who might be interested in taking a look at that and coming alongside us to donate as well. But that's just something that we incorporate as part of our fund. Okay, so this is what I'll call a recent acquisition. We closed on this almost a year ago, December of last year. So this is an example of the types of properties that we're buying within our fund. Okay, and I want to talk about this before I dive into doing a deal from beginning to end, because there are lots of different deals that are available, and just like Mike said earlier, knowing about the different nuances between different asset types and different property types and asset classes, whether it's residential or commercial, is important. So that way you can have long-term sort of sustainability and longevity within the real estate space. And so in this scenario, this is a 3-unit medical outpatient building in Abilene, Texas, that was owned by a medical group that had been operating in the same building for 14, 15 years. They were acquired by a private equity firm who wanted to help them grow and expand to multiple locations throughout West Texas. Okay? They enjoyed operating from this location so much that they wanted to, even after selling the building, continue to operate in place. We get the benefit of having a built-in tenant because this is what's called a sale-leaseback, right? So they sold it to us, and now they're leasing back from us for the next 10 years, 2 of the 3 units. One's a surgery center, one's a pain clinic. The third unit was vacant. All right, and so what we did, and so again, there are different ways to add value depending on different types of asset types and asset classes. In this case, we leased the vacant space to a comprehensive care clinic. So now you have in the building a comprehensive care clinic, aka primary care, you have pain, and then you have surgical center. So it's a really cool medical ecosystem within the same building. Because we leased up that third unit, after that then increased the net operating income significantly, right? In the same way that Marco was talking about how you bump rent over time, and there's some reasonable rent growth that you can expect. You don't, and as Mike talked about, you don't want to bank on reductions in operating expenses and gaining operational efficiencies. That's just not something that's good to sort of bank on. In our case, simply leasing up vacant space adds a tremendous amount of NOI. So we got a new appraisal, and even though we bought it for $6.5 million, which by the way is a 10.2% cap rate, that should mean something. Typically these things sell 6 to 7%. In this market, 7.1% is the cap rate. The new appraisal came in at $9.5 million. So we went from $6.5 million to $9.5 million simply by leasing up that vacant space. And apparently, once the improvements are completed, which are ongoing now, the value will then be 11.4. So, do you guys think this is a good deal? Yeah. So after this happened, I told my guys, I said, wait a second, I've been to this property one time, and that was before due diligence. My asset manager has been on the ground twice. When he's there, he calls me and he says, what do you want me to do? I'm like, just pick up some trash and make sure the place looks clean, because there's nothing really to do. We've done a lot of the work on the front end to vet these tenants. Are they credit worthy? Do we have a personal guarantee? Do we have a corporate guarantee? Like, all those things have to check the box for us to feel comfortable that over the next 10 years, they're going to continue to pay their rent as the lease calls for. And they have been by the 5th of every month via ACH. We don't have to go chase rents like we did with our Class C value add multifamily. These guys are long-term healthcare operators that run a tight ship. So this is what we're doing now exclusively. All right, let me read this, and then I'll share why I'm sharing. I'll tell you why I'm sharing this. So Romans 5:3-5 says, not only that, but we rejoice in our sufferings, knowing that suffering produces endurance, and endurance produces character, and character produces hope. And hope does not put us to shame, because God's love has been poured into our hearts through the Holy Spirit who has been given to us. I share this because anybody who gets up on stage today, or that you talk to in this space, that tells you it's been sunshine and rainbows the whole time is lying to you, okay? Or at least they're not telling you the whole truth, all right? And so, even in the midst of downtime, we want to take every opportunity we can to celebrate wins, victories along the way. But even in the midst of hard times, it's like, all right, we gotta find some joy in this somehow, because it's the endurance, it's those experiences that produce character and ultimately help you ride through the hard times. So I just want to share this with you guys, because if you're endeavoring to get into this space or learn how to do this right, it's not going to be easy, but it's worthwhile. Okay? This is for information purposes only. All the things, seek professional advice, guidance. Don't make investment decisions based on what I'm telling you today. Okay, so doing a deal from beginning to end. I took this framework from a mentor of mine, and I call it the 6 F's. And the first thing is foundation, which is essentially what Mike is talking about. In terms of asking those right questions of the sponsor, learning how this stuff works, getting educated in this stuff, okay? The next piece is, well, how do you find a deal, okay? How do you go about finding a deal? The next is, well, how do you figure the deal out, which is a lot of due diligence and underwriting and analysis, and a lot of what Marco talked about. The steps I'm going to show you are a more simplified version of that. How do you then fund it, right? It's one thing to find the deal and then analyze it, and a lot of people do get paralysis by analysis, but ultimately don't move forward. But then there's the other piece of capital formation. How do you put this thing together? The next piece is fix it and fill it. Right? So once you have the deal, once you've closed on it, now the execution part happens, and you have to lease up and fix the units and do the renovations and execute the business plan. And then finally, well, how do you exit? So let's call that flip it, right? Even though we're not, you know, this is not a fix and flip necessarily, but at the end of a certain period of time, there's an exit that needs to happen so that you can capture the value that you've created. Okay, so here's the thing. You can do this sort of as a one-man show, as a solopreneur, or one-person show, one-woman show, but the reality is that this takes a team, especially if you're trying to do it at scale. So the first thing is, with regards to foundation and learning, the internet's a great place, but so are forums and communities just like this, and there are plenty of them. You just have to be selective because they're not all created equal, okay? As far as finding deals, there's various ways to do that. I won't go through all these, you'll see them, you can read through them, but these are the different types of team members and tasks when it comes to finding these types of deals, okay? As far as triggering the deals, there's various people that you can work with that you can have on your team in order to help you do the type of analysis that's required. As far as funding it, both on the debt and equity side, there are various different players that you need to engage in order to bring all of that together. When it comes to fixing and filling it, again, executing the business plan, these are all the different types of people who may be involved in the process, whether it's a ground-up construction or value-add type of a project. In my case, for example, my case is a little bit different. I'm too chicken to close on any properties without a tenant in tow. So I sort of work it backwards, and I'm able to leverage, and sort of our secret sauce is my 20 years of healthcare experience plus relationships with strategic partners. I find that tenant before I find the building. Okay? Because if I find the tenant and the building works for them, then great. I'll already have an executed lease even before we close on the property. And that's the most important thing in the types of asset type that I'm doing now. For other things like traditional multifamily lease-up process, having a strong property management company that specializes in that type of property, in that type of class, and in that community. Ask me how I know that. So when I was in value add multifamily, and we started off with, the very first asset that we had, we started off with a property management company that told me and showed me they had some multifamily in their portfolio, but it was like 3 units, or 3 apartment buildings, and the rest of it was residential. Those are 2 different things, and ultimately they did not have the wherewithal to manage that property well. So I fired them, and I fired the second one, and finally landed on the third one. So the point is, that's a whole process, and you have to be selective about property management. And then on the back side, when you go to flip it, or sell or refinance, getting a commercial broker or a mortgage broker, depending on which strategy you use, whether it's a refi or a sale, is important. Okay, so starting off here, like I said, searching for the type of real estate training or any means that you can gain the type of knowledge, even at a base level, is absolutely key. Again, that's why, kudos to Mike and the team for putting this together. Whether we had a jam-packed full room or less, it takes a lot of work to put this together in a short amount of time, so kudos to them. But this is intended to provide value to you guys by way of the information that's being shared. If and when you do join a program like this, take full advantage of what's available in terms of webinars, coaching calls, curriculum, because there's nothing worse than paying any amount of money to have access to stuff that you then don't use, right? I had a coaching call yesterday with a student who, she's really busy, so she hasn't gotten into the curriculum, but I suggested something that she should have done like week 1, which is, why don't you post in the Facebook community that you have $100,000, $200,000 to offer in private money loans, because her chief complaint was, nobody wants to work with me, I've got this money that I want to offer in loan, and nobody wants to work with me. And I'm like, what have you done? So anyway, the point is, take advantage of the resources that are available. I'm like, so there. And by the way, so YouTube University, you have to be careful because not all content is good content, but if you do your research and figure out who's providing good factual content and follow those guys, there are some good guys in that space that are providing educational videos. So that's the foundation piece. Let's walk through the find it piece. So here's a property. So I'm going to give you some basic information on a property that we're then going to do some high-level analysis that should take no more than 15 minutes so that you can quickly sort which ones are better to do the deeper level analysis that Marco was talking about. Okay, so this is a 34,000 square foot building. It's actually three buildings, one of which is a surgical center, 24,000, that should say square feet, SF, not FK, so sorry for the foul language. Built originally in 1970. This was actually the very first surgery center ever built in America. So it's got some historic component there. And then it was knocked down and then built back up in 95. Purchase price, $6.35. Average rent in that market, $33.4 a foot, which amounts to over $1.13 million per year for all three spaces. This is an absolute triple net lease that would be in place. Again, that implies that all the operating expenses, as well as all the capital improvements, HVAC, roof, structure, foundation, all of those are the responsibility of the tenant. Which again, I want to make clear, because that's different than what we just talked about with multifamily. So there's a distinction there. I tend to like these better, in my opinion, just because it's fully built in, and as long as we know that, and what we like to do is make sure that the rent is less than 10% of the revenue for that operator, okay? And then in addition to that, again, they have to cover the operating expenses, et cetera. Debt terms here for this is sort of market for this type of product. So 7-year, 25-year AM at about 6.4% rate with 2 points on the front. And then exit cap rate for this type of asset in this market, 6.25%. And then factor in some costs on the backside to sell the property. So some quick things here. There are 4 metrics that I typically just do high level. First is price per square foot, right? So if we're in this scenario on the right hand side, so we have the purchase price divided by the square feet. So that's $187 a foot, right? What we don't know right now is whether that's good or bad, okay? But if I were to tell you that these are selling in that market right now for $300 a foot, then you would know, okay, that's a really good price. If I tell you it's selling at $150 a foot, okay, this is overpriced. Right, so we don't know. You have to know enough about the market and what the market rates are. Second thing is the cap rate. So what's interesting about this is there's 2 different quote unquote cap rates that I look at. One is called the cap rate, and the other is called yield on cost. So cap rate implies the NOI divided by the purchase price, and that gives us, in this case, a 17% cap rate, which is nuts. That's not even realistic. Okay. However, because of that, you have to incorporate, well, what's the total project cost, right? And so when we do that, and in this case it's about 13.6, we're at 9% yield on cost. That's very good, okay? So that's comparable to the other property we bought that was at 10.2. Now when we factor in the totality of the cost here at 9%, that's pretty significant. Cash on cash is the next one, simply dividing what amount of cash is left over versus the amount of equity that we put into the deal, that we would be putting into the deal. In this case, 8.4% is the cash on cash, and that's year 2. So year 1 is construction period. Not really any point to assessing what the cash on cash would be there, other than ensuring that you have an adequate amount to fully cover costs, interest reserves, operating reserves, all the things that are factored into our sources and uses to make sure that we can get through that construction period successfully. And then finally is DCR or DSCR, debt coverage ratio, okay? And looking at it in year 2 as opposed to year 1, again, because we've already factored in interest reserve and things like that. And in year 2, we're at 1.35. Most lenders like to be minimally at 1.2, but preferably at 1.25 or higher. So this is very healthy when you look at these. And again, these are high-level metrics. This is not the depth of underwriting that we're talking about that is necessary. These are some other things to look at in terms of cash flow. Typically, I'm looking at year 2, the sale price. So this is what I do. If I know in year 2 I'm already making a significant margin, if I were to sell, that's a good deal to me. We're going to hold these typically 3 to 5 years. But if in year 2 it's already showing a significant amount of potential profit, in this case, again, this is year 2 profit, 1.93x equity multiple, that's a good deal, right? So this is actually, well, let me back up. So the due diligence process goes beyond what I just shared in terms of high-level analysis. That's just initial high-level analysis. Once we determine, okay, this is good to spend more time on, now we're going through all of these things, especially, you see how long that financial column is, right? And there's other things that need to be assessed as part of the entire due diligence process. So this is part of the figure it step in all of it. So it just so happens this property I just told you about is one that we have under contract and it's closing in a couple of weeks. Okay, so this is a large surgical center in Phoenix that we have under contract. And you guys know, like I said, I don't close on these unless I have a tenant lined up. Exactly. This tenant has a $65 million endowment on their balance sheet. They have a personal guarantor whose net worth is $115 million. I know a lot about surgery centers because I did some work in anesthesia, and I also have on my team 3 surgeons and then also a dentist. They're part of our GP. Well, let me correct. One's a surgeon, one's a dentist, and then on our advisory board there are 2 orthopedic surgeons. So we know a little something about this space. Okay, so now the next F, funding. As I mentioned earlier, it's one thing to find the property, it's one thing to figure it and do the analysis, it's a whole other thing to now figure out how do I put the deal together, what kind of debt can I get on this property, what kind of equity is going to be required. I'm not going to go into the entire capital stack and all the things that are involved there. Suffice it to say that most capital stacks or the capital formation for a property entails debt, typically up to 75%, but more often 70% right now. We ourselves don't like to be above 70% just for risk purposes. And then the rest of that is equity of some type, whether it's JV equity, LP equity, GP equity, anything that the bank or the lender is not funding themselves, okay? Now, I will just take a pause to make sure that you guys understand, because if you're going to get in this space and you're going to be a deal sponsor, you have to understand the difference between a syndication versus a security. Does everybody know the difference, by the way? Okay. If you guys were, let's do an example. Let's say you 3 in the front row here wanted to go and buy a building together, and each of you had $100,000 to put together. That'll probably allow you to buy $1 million building, right? And in that case, if each of you had a role and equal vote, that would be a joint venture, right? That would not be a security because there's not a single person. Now, what's your name, sir? Steve. So now, if among the 3 of you, Steve was going to be the primary guy, and you guys were going to be more passive, each of you maybe had $400 each to contribute, so that's $800,000. I'm sorry. Each of you had $100,000 each, and then Steve was also putting $100,000 each, or $100,000 himself. Because Steve is the primary guy, even though you guys put the same amount of money in, but you're more passive, and he's the front guy making the decisions on your behalf, then that's technically a syndication, even though it's 3 people. Okay? Typically, Steve would have, in that role, would be raising from a lot more people. Okay? But even in a scenario where you've got 3 people like I just described, and there's someone who's making investment decisions in a common enterprise solely from the efforts of a promoter or a deal sponsor, then that is a syndication in which you then have to go through the proper Reg D filings and things like that. So I just want to point that out for those who may not know. There's a lot more complexity that comes when you're talking about funding it, and so just be aware of that. Okay, so now you get to the second to final step, which is really where a lot of the hard work starts to come into place, which is the operational piece and the execution of the plan. And this example really is suited for multifamily, since that's where a lot of folks start out. So I want to point out various different ways that people do add value. Excuse me, I keep pointing back there because there's a screen. But there's different ways to add value, right? So that can come in the form of rent bumps, but you can't always depend on that. It depends on what's happening in the market. There's various ways to do that. Pet fees, parking, covered parking, valet trash, all sorts of different ways that you could. Now, I don't like to bank on the additional revenue just because it's never certain that you can actually get that. In the same way that I don't like to bank on operational efficiency or reduction of expenses. I had a property once, operating expense ratio was like 64%. And we did everything imaginable, we could not get that thing down. Fortunately, I didn't bank on that. It was just sort of the reality of buying a 1960s vintage product. Okay? Maximizing occupancy. Here's the other thing that it sort of comes as part of this process is weighing retention versus rent bumps, and whether or not you actually do any kind of rent bumps during a given year, or do you keep tenants in place to maintain your occupancy and have some level of revenue. Like these are various different difficult decision points that you may have to consider. Okay, then finally, flip it. Okay, so and that really, when it comes to exiting, it comes down to one of two options, really. One is to refinance, and then the other is to sell it. And these are the reasons why you want to do one versus the other. Okay. In this space, unlike residential, the term of the loans are much shorter, either 3, 5, 7, 10 years in length, which means that at the end of that time period, you have to do something. The challenge is, depending on what's happening in the market cycle, it may be a good time to sell or refinance, and it may not be. And sometimes you can't even refinance without bringing money to closing, like Mike talked about. And so, you know, ultimately it comes down to these two different options. Number 4 should say velocity of capital, not velocity of capital. That's not a new word I just created. What's that? Should be. Should be? What would the definition be?
It's a city of the capital.
There you go. Yeah, so these are some reasons. So if you get an unsolicited offer that allows you to meet your target metrics and returns to investors sooner than expected, then you absolutely should consider that, because you don't know what the future looks like. You may not get an offer like that even if you go to market a year later. So it's a lot of nuances and intricacies when these things are at this point in the process. But there's options. There's really just two main options, as I said. Can you guys think of any other options, though? I mean, is there really any other options beyond these that you can think of?
Hold it.
Hold it? Right, so you're at year 4 on a 5-year term, and now you're at 6 months later, you're at 4.5 years, and at year 5, you have to have done something. Right? Because like I said, within commercial, there are certain terms that are much shorter than residential. So when you say hold it, that's sort of implied in the refinance, right? So you refinance so that you can extend the time that you have available on a loan, and that you can then hold the property.
Borrow against it?
So even if you borrow against it, that loan's going to mature. Right? So I just want to emphasize and point out the fact that, again, when we're talking about commercial properties, there is a certain term that will come, and you've got to pay the piper either by selling the property and fully taking out that loan, or doing some kind of a refinance to then take out the loan balance and then continue on holding the property. But these are considerations is the final point with regards to doing this kind of stuff. Okay?
Chris, you have to say a loan modification.
A loan modification? Yeah. How many lenders are out there willing to do those right now? There's some, especially if you've been in the business for a while and you've got good relationships. Those relationships take time to form, for sure. But yeah, that's another consideration, is that if there's something about the loan where, are you saying that working with the current lender to then extend is part of the modification? Yeah, that's a good point. Yeah, so that because there's a term, it's going to come to that point where something needs to be done. So that is a good point. You can either sell it, you can refinance, or if you have a good enough relationship with the lender, you can modify and get more time. Yes, sir.
One more option, seller finance.
Seller finance? Okay, so that would still be you mean you currently own it, and then you would sell it, but then you would finance it, right? I think it's an option. It also depends on how much equity you might have in the deal, whether you own it free and clear, whether there's even a lender involved at that point, because now you start talking about wrap mortgages and other things that you might need to consider, which is super high level. So, no, good, thank you. All right. So just as a reminder, these are the 6 steps here. And again, very simplified method of thinking about this entire process. Like any good business or model, there's sort of a framework that you want to look at, and there's various different steps, and you would need to sort of develop a system in order to be able to do that right. One last thing, for those who are interested in what I talked about earlier with medical real estate stuff, go ahead and scan that. If you have questions for me directly about anything, there on that 3rd bullet point, there's an email address that you can send questions to. I'm happy to help in any way that I can, whether it's simply sharing information about medical real estate, because again, that's where we specialize in, combining my healthcare background, that of my physician counterparts. Our secret sauce, and I didn't mention this because our secret sauce is we developed, one of my co-sponsors is a merchant builder for healthcare clients. And so they've been commissioned to build 250 surgical centers, either ground up or finding second generation space. 750 comprehensive care clinics, 300 med spas, and 300 regenerative medicine centers. So there's there's over $9 billion of pipeline value, and we're just trying to make a dent, bringing capital in to match it with the amount of volume that's available there. So, interested in that, let me know. Otherwise, thank you.
All right. Let's get it up for Christian one more time, guys. Just gonna get some more slides up. Don't go anywhere unless you gotta go. And you can go. If you really gotta go.